Welcome back to Be Open to Wealth. Okay, I want to start with a simple but powerful idea. If you're trading hours for dollars today, you'll always be capped by the number of hours in a day. I used to treat time like an inexhaustible resource, but once I started thinking about building systems that make money while I sleep, everything changed. This video is about practical, repeatable moves that tilt your life away from the hourly grind toward compounding passive scalable income. Over the next 10 chapters, I'm going to walk you through financial tools and strategies, studied, used, recommended to thousands of viewers. These aren't get-rich-quick schemes. They're rational, long-term approaches that add margin to your life. Whether you have $50 a month or $50,000, there's a path here for you to stop swapping time for money. My goal is to make each strategy actionable so you can take the next step tonight. First, park your emergency fund in a high-yield savings account, not a traditional checking account. The math is simple. Banks pay near zero interest. Modern online banks and credit unions offer much higher APYs. That extra yield compounds for money you need in months, not years. It's the safest place to earn something meaningful. I treat it like a foundation liquid safe, slightly productive. It keeps you from rating long-term investments during market hiccups and gives you breathing room to make smarter financial choices. Index funds are the cornerstone of long-term wealth building because they deliver broad market exposure at rock-bottom fees. Instead of betting on a single stock, you buy a slice of the entire market. S&P 500 total market international indexes, and let the economy's growth work for you. Over decades, low cost plus diversification equals a compounding machine that wins more often than active managers. I always emphasize time in the market over timing the market. Reinvest dividends, minimize fees, be patient. The math favors long-term investors who keep expenses low and emotions out of the equation. Dividend stocks let you convert shares into cash flow. You can receive regular income. You can reinvest those dividends to buy more shares, accelerating compound growth. For someone moving off hourly work, steady dividend checks can replace parts of monthly income. Not all dividend stocks are equal. Look for sustainable payout ratios, strong cash flow, business models that survive recessions. I like combining blue-chip dividend payers for stability with a few higher-yield names for income. Keep a long-term lens, reinvest where sensible, and treat dividends as an engine for both cash flow and compounding. Chapter 4. Dollar cost averaging is one of the simplest behavioral tools in investing. Commit to investing a fixed amount on a regular schedule, regardless of market moves. This reduces the emotional urge to time buys and smooths out purchase prices over time. For most people, it's the practical way to build a meaningful position without needing perfect market timing. Automate your contributions to index funds, ETFs, or retirement accounts, and let this routine remove guesswork. Over years, DCA helps you buy more when prices are lower and less when they're higher, which can improve average cost and reduce anxiety. Discipline beats speculation, and automation enforces discipline, you know. Chapter 5. Use tax-advantaged accounts to turbocharge long-term returns. 401ks, IRAs, employer 401k matches are literally free money. Max that match before you do anything else. Traditional accounts give you tax-deferred growth. Roth vehicles provide tax-free withdrawals in retirement. Both offer ways to keep more of your gains over time. Contribute consistently, prioritize company match, and choose low-cost index funds inside these wrappers. The tax drag over decades can erase a big chunk of gains, so minimizing taxes through these accounts is one of the most powerful moves you can make without increasing risk. Chapter 6. Rental properties are a classic way to generate cash flow and benefit from appreciation, but they come with management responsibilities. The basics are straightforward. Buy a property with positive cash flow, vet tenants carefully, and maintain a reserve for repairs. When done well, rentals produce monthly income, while the property appreciates over years. If being a hands-on landlord isn't for you, hire a property manager. Expect to pay 8 to 12% of rent but gain time back. Leverage can amplify returns but increases risk, so run conservative numbers. Rental real estate is less passive than stocks, but it can be a predictable, inflation-resistant income stream when managed properly. Real estate investment trusts give you exposure to commercial and residential property without buying physical buildings. They're publicly traded, liquid, and often pay attractive dividends because they distribute most income to shareholders. REITs let you capture property cash flow and diversification with the simplicity of stock investing. They can be more sensitive to interest rate moves, industrial residential healthcare, and balance them in a broader portfolio. For many investors, REITs are the easiest way to add property-like income to a portfolio. Chapter 8. Robo-advisors automate portfolio construction, rebalancing, tax loss harvesting at a fraction of the cost of full-service advisors. If you want a hands-off, professionally designed allocation without thinking about it, robo-platforms are ideal. Thanks for watching.